Guys, welcome to another Ultimate Edge webinar series. This on creative financing options for unique situations. So we're going to have an ongoing series on that. My name is John Murphy with Bay Equity Home Loans, and we're just going to get right into it here. Today, we're going to talk about bridge loans, how they work, and when you may want to use one. But first, I have a question for you. Why is money also called dough? Well, it's because we all need it. Moving along, my second question is, when does strategy beat rate? Well, it beats rate when it makes or saves you a pile of dough, right? When it gets you into the house of your dreams, and when it solves a problem. And we are problem solvers is what we are here. The way we solve problems, we have what I call a loan toolbox, and it's got lots of different kinds of loans that we do. Conventional loans, asset loans, no income verifier loans, DSCR loans, all of the above. So there are lots of different problems that we find that people have in acquiring and holding and maintaining and rehabbing real estate, that kind of thing. And different loans fit different people in different situations. So today we're going to talk about a normal situation, which is a purchase of an owner-occupied home. And let's say the purchase price for this little home you see is $850,000. The problem is that the buyer does not have an adequate down payment to purchase the home, their little dream home. However, they have a good situation. They own their current residence and it has lots of equity. Let's assume their current home pictured there is worth $600,000 and they owe $200,000. So they have $400,000 worth of equity in their current home. So they have some solutions. One is they can make an offer on the new home that is contingent on the sale of their current home. The problem with that, of course, is that not a lot of sellers are accepting contingent offers because they don't know how long it's going to take, and somebody else might come along the next day and give an offer that's not contingent on the sale of a home, and they want to close sooner than later and all of that. So that may not meet the seller's needs for that home, and that could be a problem. However, the buyer could potentially access the equity in their home with a HELOC on their current home and use that for the down payment and buy the new home. That presents some challenges as well. One is it takes potentially 2 weeks to 8 weeks to get a HELOC, depending on where you're going. So it takes time. The seller doesn't know that the buyer is going to qualify for the HELOC, so they may not be sure of that. And then potentially the worst problem of all is, if you do that, the buyer has the HELOC payment, they have the payment on the $200,000 loan on their house right now, and they have the new payment they're going to get on the house that they purchased, all of that into their debt to income ratio, and they simply may not qualify with 3 different mortgage payments in their debt ratio. That can be a problem. So one other possible solution is to use what's called a bridge loan to purchase the new house with no contingency whatsoever. It doesn't impact the seller at all. They can move forward with the sale. And that's where we dig deep into our loan toolbox and we pull out a bridge loan. So what is a bridge loan? It's a loan that we put on what's called the departing residence and on the new home that someone is purchasing. The departing residence is the home that the current buyer already owns. They're residing in it and they're departing it. They're leaving that residence to purchase the new home. That's why it's called the departing residence. This is also known as a cross-collateralization loan. So look at it this way. What if they owned both homes at the same time? So the total value of the real estate owned would be the $600,000 plus the $850,000 for the other home. They would own $1.45 million of real estate. And let's say they only owed the $200,000. There's a lot of equity there that they could potentially use to do a lot of things, including purchasing homes. Well, that's exactly how the lender looks at this. They do what's called a bridge loan, and they collateralize both homes with the new loan. So the lender looks at it that way, that there's $1.45 million worth of equity value in the home. And there's only one loan that we're worried about. That's the loan on their current home of $200,000. So they have what I call bridge loan math. The lender is going to loan up to 75% loan to value of the properties. This is really pretty simple how we figure out bridge loans, guys. You take the value of the current home, $600,000, add that to the value of the home they want to buy, $850,000, you get $1.45 million. The lender will loan up to 75% of the value of that. So we have $1,087,500 to deal with here. Now, I want you to know that there are different kind of bridge loans, and I'm going to show you 2 different ones in this particular presentation, and there are some slight differences there. It's not just 75% loan to value. But if you use this math, and it works, it's probably likely going to work in our situation. So the rest of the math looks like this. We take the $887,500 we used and we subtract out, we take the $1,087,500, we subtract out the $200,000, we end up with $887,500, which is more than enough in this particular situation to purchase that brand new home for $850,000. So in this situation, these borrowers could potentially, now there's qualification, of course, which we're going to talk about in just a minute here, use the equity in their current home to purchase that home with 100% financing to buy that home. They don't have to have a down payment. Now, lots of times the math works out that they need a $10,000 or a $20,000 down payment, and oftentimes they have that. They just don't have the larger 20% down payment that they want to use to get into the home. So that's how it works. We look at the available equity after doing that math there, and if there's enough loan available to buy the home, they can buy the home. So the buyer buys the new home with no contingency using the available funds from the bridge loan from our math there. Remember, the bridge loan uses both properties as collateral. That's why the lender is willing to do that. And then the buyer moves into the new home. They eventually sell their departing residence. They have 1 year to do that, 12 months typically on these bridge loans. That pays down the bridge loan with proceeds from the sale of their home. They end up with a smaller permanent loan on their new home. The dust settles, they got the home, and they got the loan that they wanted to have. Brittany, are there any questions in the comment section or anything like that I can answer right now?
No questions right now.
All right, thanks so much. Okay, but there are a couple different versions of this loan we're going to talk about. There is one version where we use just one loan. Here's how that works. You can do owner-occupied purchase, and you can also do new construction. So you can do a bridge loan to build a new home using the equity in your current home as the down payment and potentially the purchase price of the land and all of that. So that's kind of cool. You can also purchase a second home, and in case-by-case scenarios, we can do non-owner occupied. So you can potentially collateralize a rental property and buy a rental property. You can potentially collateralize your residence and buy a rental property. You can do all kinds of things with the bridge loan. You can buy single-family residences, condos, PUDs, townhouses, and manufactured homes with this particular loan. And once again, we'll go up to 75% of the value of the homes with a maximum loan amount there of $1.5 million. We will do higher loans up to $3 million, but the loan values get reduced on that. And the loan is not available in Hawaii. So for our Hawaii agents and our Hawaii clients, you cannot use this loan, but don't despair. We're going to show you one that you can in just a little bit here. So the qualifications on the one loan, cross-collateralization loan, is the borrower is going to be qualified on the permanent loan after the principal reduction is made. So what I just said there, let's say they borrow the $800 and some thousand on the new home that they're buying, but after they sell their current home, they pay that loan down, and let's say the new loan ends up being $600,000. They're going to qualify with the underwriter with that loan with the permanent payment. So we don't include their current loan in their residence, the $200,000 loan, which doesn't get paid off. That stays there in place on the residence. And we don't include the larger portion of the new loan, the $800,000 bridge loan, as qualifying purposes. Now understand they get the $800,000, that's how they purchase the new home, but they only have to qualify with the lower payment. The maximum debt to income ratio with this particular lender is 43%. That's a relatively conservative debt ratio. Keep that in mind. Fannie Mae will oftentimes go up to 49% when you're just purchasing home with a 20% down payment. This lender is a portfolio lender. They set their own rules. That's their debt ratio. They also require 12 months reserves required on the new home. So obviously the situation with this loan is they're making the payment on the larger loan, even though they don't have to qualify for it, they still have to make it. They also have to make the payment on the $200,000 loan that's left remaining on the departing residence. So the lender wants to note that they have a certain amount of reserves, in this case, 12 months of reserves payments required on the new home. So they know they have the ability to get through the next year making those payments. It's important to them. The seller contributions are allowed. Sellers can contribute to closing costs with this loan. Gift funds from a relative are allowed for the down payment. So let's say they didn't want to borrow the whole $800,000 and a relative was willing to gift them $100,000 or so. That is allowed following the regular gift fund process that we have. And understand that because this loan is collateralizing their residence, they're effectively refinancing their residence, and there's a 3-day right of rescission that happens on owner-occupied refinances. So we're not going to close the loan until 3 days after they have signed on the loan documents, and you want to keep that in mind for the purchase scenario because it's going to get delayed 3 days because of that particular feature. All right, let's switch gears now. We're going to look at the bridge loan with 2 loans. So this is a different lender, a different process. It solves the same problem in a slightly different manner. So if we're going to get one loan up to 75% loan to value on the departing residence, so that's the home that they have. In this particular case, it pays off the underlying lien. So they refinance that $600,000 loan, 75% of the value of that up to, and refinance the lien there, and they only have one loan left, which is the new bridge loan. There are no payments required on that bridge loan for a period of time, and the term of the loan is 12 months. So they put a new loan on their departing residence, pays off the old loan, no payments are required there. It accrues interest, and I'll show you the interest rate in just a little bit here, over time, and they have up to 12 months to sell that home and pay off that loan. They take the proceeds from that loan and they get that as the down payment, and they get a second loan to make up for the difference that they need up to 80% of the value on the new home. They don't have to borrow 80% if they don't need it, but the lender will loan up to 80% in this particular situation. That's the permanent loan. That's the loan that they're going to end up with when the dust settles and they sell their departing residence and all of that. That'll be the loan that they have at the end there. So with the 2 loan bridge loan scenario, you can do owner occupied second home and non-owner occupied again. They'll lend on single family residence, condos, PUDs, townhouses, and modular homes. A modular home is not a manufactured home. Manufactured is the home that rolls in on its own frame with wheels, and they take the wheels off and bolt it down to the site there. A modular home is a home that was built off site. They load it onto a semi-trailer, doesn't have its own wheels and axles. They truck it over to the site, pick it up off the semi-trailer, and set it onto a foundation. It's a different style of construction there. An interesting thing about this particular loan is it will use various income types available. So the normal way we verify the income is with full doc, we call it. It means W-2s and pay stubs if you're a W-2 wage earner, 2 years of tax returns if you're self-employed, 2 years of tax returns if you have rental history and all of that. But if that doesn't work for you with this particular loan, we can actually use bank statements to verify income and not use W-2s and pay stubs. It's one of the advantages this particular strategy has over the other one. And we'll also use what's called asset depletion for income as well. Asset depletion is a term we use that if someone has a large amount of liquid assets in the stock market, in a money market account, maybe even in a 401k or whatever it is, that they're not going to use for anything to do with a loan, no down payment or anything like that, we can calculate an income scenario coming from those liquid assets if they had to use them, and use that as additional qualifying income to help them get it to the home. It works very well for people that have large amounts of assets, of course. And guess what? This loan is available in Hawaii. We can do it in all the states we do business in, which is all the western states in Hawaii. The qualification on this particular loan is a little easier than the other one. The borrower's qualified on the permanent loan on the home they're purchasing. So that up to 80% loan to value purchase loan that we talked about, the payment on that with taxes and insurance, that's what they qualify on, with one small exception. We need to take that if there's homeowners association dues on the departing residence, because those oftentimes aren't impounded, we need to add those into the debt to income ratio for qualifying purposes only. But the maximum debt ratio here is 50%. So you can qualify for potentially more loan with this particular program. We're going to impound 1 year's worth of property taxes on the departing residence. The reason for that, of course, is that home could sit there for 12 months. The lender wants to make sure the taxes are going to get paid for that 12-month period. So they're going to impound any funds needed to pay the taxes. If it sells in less time, any funds that are left there in the impound account go to the borrower. They're also going to pay 1 year's hazard insurance and 1 year flood insurance if it's required upfront. So obviously they want the taxes and insurance covered for 12 months on the departing residents. Seller contributions are allowed. Seller can contribute to closing costs. Gift funds from relative are allowed. And the same 3-day right of rescission applies on the refinance of their existing residence, because that's a federal regulation that we need to adhere to for that. All right, so let's compare and contrast these two loans. With the one loan, today's rate as of we are in August of 2023, guys, the rate on that loan today is 7.25%, has an APR, as you can see, of 7.734%. That is on the permanent loan when the dust settles at 7.25%. The rate on the larger loan during the period of the bridge period is 1/4% higher. So the large loan that they get, potentially $800,000 in this case, they're going to be making payments at 7.5% on that loan. Then they sell the house, pay down that loan, get the new loan in place. The lender recasts that loan to a 7.25% rate in this case and make the payments there for the next 30 years. As opposed to the two loan one has two loans. One is the bridge loan. That is the loan that goes on the departing residents where they don't make any payments. The rate on that loan is 8.5%. You can see the APR, 8.93. The permanent loan is 7.875% as of today with that loan. That's an apples and apples comparison. That's a 75% loan to value. They can go up to 80% loan to value with the two loan scenario if needed. The rate goes up a little bit when they do. I wanted to show you an apples and apples comparison here so you can see that the two loan rate is higher than the one loan rate when it gets done. So that's kind of one of the downsides of doing that particular strategy. Payments required on the one loan are on the two loans. They have the big loan and the remaining loan. So the remaining loan is on the departing residents. They still need to continue to make payments on that $200,000 loan, and they need to make payments on the larger cross-collateralized loan. Whereas on the two loan scenario, they don't make any payments on the bridge loan. Remember, it paid off the $200,000 loan, so that loan is gone. And it's just a bridge loan at 75% of the value, and it accrues interest at 8.5%, but no payments are required. They only need to make the payment on their permanent loan at the 7.875% in this case. So it's a much easier payment strategy with them. It should be noted that the two loan ones actually has two separate loans. So there's two escrows and two titles. So there are potentially higher closing costs with that scenario, but we're going to get some similarities here. Both of these strategies require two appraisals. We're going to get an appraisal on the departing residents and an appraisal on the house they're buying for both scenarios. Both of them will require title policies for the loan. So there's title policies. So the extra costs are there. There's an extra escrow fee and some other fees, but it's not that significant. But I do want you to be aware that they are there. And then with the one loan, when the house sells, it pays down the cross-collateralized loan, remaining balance recast for 30 years, and they're done. On the two loans, when it house sells, it pays off the bridge loan, and it's out of there, they're done. Any available funds from the sale of either of those scenarios comes over to the buyer at that time. They put it in their bank, pay off the loan, pay down the loan, and they have the permanent loan in place on the two loan scenario, and they're done. So that's kind of it, comparing and contrasting these loans. Any questions or stories? Brittany, are there any questions in the comment box?
Not right now. The Q&A is open if anybody would like to join in there, and comments or questions can go in there.
Feel free to do that, guys. I do want to let you know, if you're a real estate agent, that we can co-market this loan with you. There's the flyer, buy a new home without having sold your old home. So in addition to my smiling face that you see there, if you want to co-market with us, your smiling face can go on there as well. And you could use that at open houses or whatever you want to do to market to clients to let them know that we do have bridge financing available for them. And I'm going to give you one more question. Brittany, why did the mortgage lender go out of business? Do you know?
I don't know. Tell me.
Lack of interest.
Good
Guys,
one.
for those of you who joined our webinar today, thank you so much for joining. We appreciate that. We're going to continue with our Ultimate Edge webinar series, and we'll do more creative loan series as part of this. This is also going to be in our YouTube channel. My contact information will be all over the place in the YouTube. Feel free to reach out and give us a call if you have any questions at all. and we can go from there. Thanks for attending the webinar today, guys. Thanks for watching on YouTube. We appreciate it. Bye-bye.